before looking for entries, liquidity sweeps, order blocks, fair value gaps, or any advanced smart money concept. You first need to understand market structure. If you cannot read structure correctly, every other concept becomes harder to apply. At its core, price usually moves through three conditions: uptrend, downtrend, or consolidation. So before marking zones, choosing a bias, or planning an entry, we need to identify what condition the market is in. Once this foundation is clear, it becomes much easier to separate clean structure from noise, real continuation from retracement, and valid reversals from simple internal movements. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. So, let's begin with the foundation. First, consider an idealized version of market structure, a perfect uptrend. I call this idealized because it is rare to see an uptrend in real market conditions that follows this pattern perfectly. Markets usually do not move with that level of predictability. Nevertheless, to enhance our understanding of uptrends, let's examine this ideal model before shifting our focus to the more realistic uptrend structures that are more commonly observed. In a typical uptrend, prices will consistently create higher highs and higher lows. The pattern generally sees prices surpassing previous highs while sustaining the lows. An uptrend concludes when there is a break below one of the significant lows. To preserve the continuity of an uptrend, it's essential that these major lows remain unbroken. Additionally, when a price exceeds a major high, it results in a structural break and forms a demand zone, indicative of a break of structure, or BOS. Accurately identifying major highs and lows is crucial because it allows us to recognize signals for potential trend reversals or continuations. Without correctly pinpointing these key points, traders are at risk of misinterpreting market signals and potentially entering trades on the wrong side of the market. These principles are equally applicable in bearish scenarios. During downtrends, prices consistently form a sequence of lower lows and lower highs. In such scenarios, prices tend to break below previous lows while still respecting the previous highs. Let's explore the details of a realistic market structure, focusing on the more commonly observed uptrend patterns in the market. Consider a scenario where the price surpasses previous highs, breaking upward. At this juncture, a key question emerges. How do we pinpoint valid major highs and lows? To address this, let's examine the left side of the market structure. It is evident that the price underwent an upward trajectory until it began to retrace. The peak reached before this retracement is deemed the major high. Conversely, the lowest point during the bullish wave that triggered this upward movement and led to a break of structure and a new high is recognized as the major low. These 2 points are the critical external structures of the market, and any structure that develops between them is considered an internal structure. When the price surpasses the major high, marking a break of structure, BOS, it indicates a continuation of the upward trend. On the other hand, if the price drops below the major low, this should be interpreted as a signal of a trend reversal. The internal price actions within these external structures are secondary, provided the price stays above the most recent major low. Maintaining this condition signals that the market remains in a bullish phase. You might wonder why this low at the extreme is treated as the major low. The reason is that it represents the ultimate low point before the price starts its upward trajectory. This particular point is essential as it's the pivotal low that catalyzed the upward movement and the subsequent break of structure. Now, let's transition to the bearish scenario, which mirrors the bullish scenario. The bearish wave begins, leading to a structural break. We also identify a major low, marking the lowest point reached after the structural break. These 2 points, a major high and low, act as our external structures, while all structures developed between them are viewed as internal. Should the price break these major lows downward, it signals a continuation of the trend as illustrated here. Conversely, if the price climbs above the major high, This would be indicative of a potential trend reversal. In simpler terms, the internal price actions within these external boundaries are secondary, as long as the price remains below the most recent major high, signaling a bearish market. As the price retraces upward, it establishes a series of internal highs and lows within our defined trading range, yet it eventually ascends, breaking the recent major low downward. This internal high, situated at the extreme, is now recognized as the new major high because it marks the highest point reached before the price initiated a strong bearish push, resulting in another structural break. Following this, the price undergoes another retracement, forming another major low. After establishing various internal structures, the price sustains its downward momentum, creating a sequence of lower lows and lower highs. Now that we understand the difference between ideal structure and realistic structure, the next step is to understand how price actually moves inside that structure. Because not every retracement is a real pullback, and not every small movement should be treated as a meaningful structural shift. To read market structure correctly, we first need to separate three types of movement: impulse, correction, and continuation. Each of these movements is formed through internal candlestick structures. Now let us take a closer look at each component in detail. Impulse movements represent strong directional moves that align with the prevailing trend. Within an impulse phase, price moves with strength and conviction, often creating clear bullish or bearish trends. This stage is typically driven by strong market sentiment, where either buyers or sellers are clearly in control. For instance, if we look at a bullish sequence of candles, we can observe that price forms a series of smaller candlestick-based impulse and corrective movements that collectively push price higher until a swing high is reached. From a structural perspective, it is important to interpret these internal bullish formations as a single unified bullish impulse leg. The reason for this is that price has not yet taken out or meaningfully swept the liquidity resting below any of the previous minor internal lows. Even so, when viewed at the candlestick level, this movement is classified as an impulse. Following this, we observe a valid pullback, where price breaks and closes below the most recent bullish candle, forming a bearish candle that represents a minor correction. After that, another impulsive movement appears, which we define as a minor continuation. As we can see, price continues to follow this pattern repeatedly until it reaches the swing high, and in this example, forms a deeper corrective phase. With that established, we can now shift our focus to corrective movement. A corrective move is essentially a temporary counter-trend phase that moves against the primary direction of price. Therefore, within a bullish market structure, a correction is confirmed when price breaks below an internal pullback or internal low, or when it sweeps the liquidity associated with that level through a wick. In this scenario, the correction is represented by a sequence of 3 bearish candles, showing the price has moved lower and taken the liquidity below the most recent pullback low. Shortly after, price resumes its upward movement and eventually breaks above the most recent swing high. This progression leads us to classify the move as a continuation. In a similar example, within the second candle sequence, we again observe price forming a series of smaller internal impulse and corrective movements pushing upward until it reaches a brief pause and then retraces lower through another set of 3 bearish candles. Since price has not broken the lowest point of any internal pullback or internal low, nor retraced to at least the 0.382 Fibonacci level, which is an important rule within the ComLucro framework, and has also failed to sweep the liquidity below these levels in this sequence, we cannot classify this as a valid corrective movement. Therefore, this price action should be interpreted as a single impulsive move without any correction. These concepts also apply to bearish market conditions. Now that we understand how price moves through impulse, correction, and continuation, we need to define what actually confirms structure. Because a market structure break is not valid just because price touches a level or leaves a wick beyond it. To avoid confusing liquidity sweeps with real structural breaks, we need clear rules for a valid break of structure. Let's dive into these key points and rules. A valid break of structure is confirmed when the price not only breaks, but also closes above the most recent higher high with the candle's body. This validation holds even if the price retraces downwards immediately after the break. In such instances, the market establishes a new major high and major low, defining a new trading range. Should the price then break this newly established major low heading downwards, it suggests a potential trend reversal, indicating a shift from a bullish to a bearish stance, a change of character, or CHoCH. Continuing our exploration, if the price breaks the previous higher high with a long wick or shadow, and the body of the candle closes below the high's range, and if the subsequent candle's wick does not exceed the first candle's wick, this does not qualify as a valid break of structure. In this instance, the resulting low is treated as an internal structure within the trading range. For a reliable indication of a trend reversal or a valid change of character, we need to observe the price breaking below the significant low at the extreme, rather than merely breaking above an internal high. Now let's consider a different scenario. If the price surpasses the recent higher high with a wick, and the body of the first candle closes below the high's range, but the subsequent candle's wick exceeds the first candle's wick, we then recognize this as a valid bullish break of structure. Here, a new major high and a new major low are established, outlining our updated trading range. The internal price action within this defined range is less significant, provided the price remains above our newly established major low, which signifies a bullish market. If the price later breaks this newly formed low downward, it then acts as a clear indicator of a trend reversal or a valid change of character. Transitioning to the bearish scenario, which mirrors the bullish one. For a bearish market structure to confirm a valid break of structure, the price must break and close below the most recent lower low with the candle's body. If the price breaks the newly created major high upwards, this signals a trend reversal, suggesting that control has shifted from sellers to buyers. Conversely, if the price breaks the recent lower low with a long shadow or wick and the candle's body closes above its range without the subsequent candle's shadow exceeding the first candle's wick, this is not considered a valid break of structure. To confirm a genuine break of structure, the price must close below the low's range with the candle's body. Moreover, if the subsequent candle's wick surpasses the first candle's wick and closes above the low's range, this then qualifies as a valid break of structure. We must also update our major low and major high accordingly. As long as the price stays below our newly established major high, the market is considered bearish. Only if the price breaks this new high upward do we acknowledge it as a valid signal for a trend reversal or a major change in character. Having explored various types and scenarios of break of structure patterns, and now possessing a solid understanding of what constitutes a valid BOS, let's delve into another key aspect of market structure mapping, the change of character, or CHoCH. The first step in identifying a valid change of character involves determining the general market direction, whether it's an uptrend or downtrend. Next, you need to highlight the valid breaks of structure on your price chart. In the bullish scenario, consider how the price forms a series of valid breaks of structure. The low and high that define these breaks are our major structures associated with the first valid bullish BOS. As previously noted, any price action that occurs between these two structures is deemed internal. Change of character patterns can be categorized into two types, minor and major. For instance, each time the price breaks any internal low, it signals a minor change of character. It's crucial to understand that a minor change of character alone should not be taken as an indication of a complete market structure shift. Here, we encounter a common pitfall in the market. Many novice traders who have not properly identified the market structure often misinterpret a minor change of character as a signal for a reversal in market direction. Believing that the bullish phase has ended, they might think it's an ideal time to enter a short position. Typically, they place their stop loss just above the internal high. However, contrary to their expectations, after a brief retracement, the price climbs again and continues its upward trajectory. This often results in hitting the stop loss of traders who took short positions. They frequently fail to understand why their stop loss was triggered by the price and tend to repeat this mistake. What they miss is a crucial detail. The price did not break the major low that would confirm a shift in market structure. They should not enter a short position until the price breaks the last major low to the downside. Their perceived change of character was invalid, and the price was merely in its retracement phase before resuming its primary upward direction. To capture a valid market structure shift signal, traders should patiently wait for the price to establish a major change of character by breaking and closing below the last major low that initiated the upward movement leading to the bullish break of structure. Furthermore, it's essential to remember that in a bullish scenario, a change of character pattern is only considered valid if the price breaks and closes below the last major low using the body of the candle. If the price breaks the most recent high with a long wick or shadow and then closes within the high's range, the change of character is deemed invalid and cannot be seen as a decisive market structure shift. This principle is mirrored in bearish scenarios. For a change of character to be considered valid and highly probable, the price must break and close above the recent major high with the candle's body. Any penetration merely by a shadow or wick is regarded as insufficient. Now that we understand BOS and CHoCH, the next step is learning how to interpret pullbacks correctly, because many apparent reversals are not real reversals. They are simply retracements inside the larger structure. To avoid this mistake, we need to understand which swing points are truly important and which ones are only minor internal reactions. When the market is moving in a clean uptrend and price keeps advancing, it consistently respects demand zones and breaks structure to the upside. In classical terms, it prints higher highs and higher lows. Inside this type of trend, what we call a pullback is simply a retracement of price before continuation. On the ComLucro channel, pullback and retracement mean the same thing. Every time a structural level is broken, a fresh demand zone is formed, and that zone often becomes the reference area where the pullback reacts. A break of structure is only considered valid when a candle clearly breaks through and closes above the level. A wick extending above the high shows that buyers managed to push price higher, but it also signals rejection back into the range. From a pullback perspective, this type of move often represents liquidity being taken, not a real retracement. Many traders confuse these wicks and liquidity grabs with pullbacks, but they are not the same thing. When price produces another break with a strong full-bodied candle, this confirms a valid breakout. At that moment, we can define this level as the most recent higher low. This higher low is the key reference for identifying a healthy pullback. As long as price holds above this area, the bullish bias remains intact, and the retracement is considered corrective. When price pulls back into this zone and respects it, we classify that move as a valid pullback. If a clear reversal pattern appears, it may be reasonable to look for a short trade targeting this demand zone, since it still functions as solid support. A change in character takes place when price breaks and closes below this higher low. When that happens, the move is no longer a pullback or a retracement. Buyer control is being challenged, and the market may be shifting structure into a potential downtrend. The same logic applies in a bearish environment. However, this creates another major problem for most traders. Even after understanding break of structure and change of character, many traders still struggle to identify which pullbacks are truly valid and which ones are simply temporary reactions inside the trend. That is exactly why this next principle becomes so important, because not every swing high or swing low has the same structural value. The first concept we will cover is how to separate major swings from minor swings, because this distinction is essential to identify valid pullbacks. Not every swing high or swing low defines a retracement. In an uptrend, major swing lows are the levels that matter, because they are the zones from which breaks of structure originate. This level represents the starting point of the impulsive move after a previous high is taken, and it defines where a pullback is allowed to retrace without invalidating the trend. A change of character happens when price breaks and closes below this specific level. When that occurs, the move is no longer a pullback or a retracement. The remaining swing lows are classified as minor, and a break below them does not signal a genuine reversal. These minor breaks often happen during pullbacks and should not be mistaken for a change in direction. Now, here is a key point to understand. A level can only be classified as a major swing after a valid break of structure has occurred. Until that happens, a retracement cannot be properly defined. This level represents the highest price recently traded, and a break of structure is only valid when price clearly moves through it with conviction. Only after that confirmation can we label a swing as major. For that reason, this level becomes the reference point for pullbacks, while the remaining swings are treated as minor reactions. A break below a minor swing low still signals a temporary loss of bullish strength, but not a reversal. In some situations, such as a reversal liquidity sweep coming from a higher time frame key level, a short trade may be considered targeting the major swing low. This is because price often reacts when it taps into that level. However, this type of trade goes against the primary trend and carries higher risk, which is why most of the time these moves are better understood as part of a pullback rather than a trend change. On the Euro-Dollar 1-hour chart, we can observe 1, 2, and 3 moves breaking below this low, establishing a downtrend. The origin of this impulsive move is defined as the major high. As long as price stays below this level, the market remains bearish, and any move back toward it is treated as a pullback, not a reversal. Let us continue the process of identifying major and minor swings, because this is critical to reading pullbacks correctly. When price breaks structure and forms a new low, the level where that break of structure started becomes the new major swing. This level defines the maximum area where a pullback can retrace without invalidating the trend. If price only leaves a wick below the recent low, this is not a valid break of structure. It is classified as a minor swing. These types of moves happen frequently during pullbacks and should not be mistaken for structural shifts. A move above a minor swing high does not signal a change of character. It is often just part of the retracement. A real reversal only occurs when price breaks and closes above the major high. Until that happens, all retracements towards structure are treated as pullbacks inside the trend. We continue marking major and minor swing highs until a valid change of character appears. Only at that point can we say that the pullback has failed and that the market may be transitioning into a new directional bias. In this example, we see what appears to be a change of character defined by 2 clear wicks breaking above the last major swing high. This is where many traders misread pullbacks as reversals. However, it's important to emphasize that a change of character is only valid when either multiple wicks clearly exceed the level, or when a candle decisively closes beyond it, followed by a confirmed break of structure. Without that sequence, the move is often just liquidity taken during a pullback. Another factor that strengthens the validity of a true change of character is when price breaks through the last 2 swings, not just one. If this does not happen, as in this case, the move is classified as a fake change of character and the prior trend remains intact. This was the first criterion for defining a major swing, the level that becomes the origin of a break of structure. The same logic applies in reverse for bullish scenarios. There are 2 additional criteria that help us identify major swings and confirm whether a retracement is a valid pullback or the beginning of a real reversal. The second criterion is the fair value gap. In the ComLucro framework, fair value gaps help us determine the quality of a pullback. A bullish fair value gap represents a buy-side imbalance, where buying pressure clearly exceeds selling pressure, often linked to institutional activity. When a pullback retraces into a demand zone that created a fair value gap, we expect a reaction, because price is rebalancing an imbalance, not reversing the trend. For this reason, demand zones that include fair value gaps are treated as major reference points for pullbacks, while zones without imbalances are considered minor. When price breaks below a major swing that created an imbalance, this signals a meaningful shift in momentum. At that point, the move is no longer a pullback or a retracement, and it may point to a potential reversal. The same logic applies in bearish scenarios, where pullbacks react into supply zones that contain imbalances. Now let us move to the third and final criterion that helps us define a valid pullback: the depth of the retracement. In the ComLucro framework, pullback and retracement mean the same thing. Consider this example of an upward impulsive leg. After the impulse, price forms two retracement candles. But this pullback does not reach the 38.2% Fibonacci retracement level. Because this minimum depth is not achieved, this retracement is considered invalid. As a result, this move is not classified as a real pullback. Instead of being treated as an impulse followed by a correction, the next push higher is read as a continuation of the same impulsive leg. In other words, what looks like a pullback on the chart is actually just part of the impulse, not a completed retracement. This leads us to a key rule in the ComLucro framework. For a pullback or retracement to define a valid swing and separate impulsive legs, it must reach at least the 38.2% Fibonacci retracement of the prior impulse. If this condition is not met, the move is treated as one continuous impulse and cannot be used to define a major swing or a valid pullback. Now take a look at these examples. In the first case, none of the pullback criteria are present, so this level is classified as a minor swing. Any retracement around this area is considered weak and unreliable. In the second case, we have a confirmed break of structure and a valid retracement that reaches at least the 38.2% level. But there is no imbalance. For that reason, this level qualifies as a valid pullback reference, but only with 2 out of 3 criteria met. In the next example, we see an imbalance and a valid retracement to 38.2% or more, but there is no confirmed break of structure. This is also treated as a 2-star pullback because one of the core conditions is missing. In the final example, all 3 conditions are present. The swing created an imbalance, broke structure, and showed a proper retracement. This is what we classify as a 3-star pullback, the highest quality pullback in the ComLucro framework. When price breaks and closes below this low, the pullback has failed. That break confirms a valid change of character, signaling a true shift in market direction and momentum. But even after understanding pullbacks, structure shifts, and valid reversals, there is still another important layer that most traders fail to recognize. The market does not move randomly between structure points. Very often, price intentionally moves toward areas where liquidity is resting before the real continuation begins. This brings us directly into liquidity sweep zones, one of the most important concepts in institutional trading. If we want to understand why price moves the way it does, we need to understand why the market constantly targets the areas where retail traders place their stop losses. Let us simplify the process. Price is trending higher, printing higher highs and higher lows. Then a pullback occurs and equal lows are formed. These levels are common areas where retail traders place their stop losses. Price briefly moves below those lows, triggering the stops and releasing a wave of sell orders into the market. But here is the key point. Price does not continue lower. Instead, it quickly reverses direction. The reason is that institutions are stepping in and using that liquidity to build large buy positions. Once price rallies upward and breaks the previous high, we have confirmation of strong demand. At that point, we mark the zone and wait for price to come back. When price reacts there, that becomes our entry signal. Simple in concept, but extremely powerful in execution. However, liquidity alone is not enough. One of the biggest mistakes traders make is focusing only on the lower time frame, while completely ignoring the broader market context. This is exactly why many traders get trapped taking reversals against the higher time frame direction without even realizing it. This is why higher time frame alignment becomes so important. Many traders misread market structure because they analyze only the lower time frame without understanding the broader narrative that is controlling price direction. However, professional traders approach the market differently by combining higher time frame bias, structural confirmation, and lower time frame execution into one unified framework. In this example, we will use the weekly chart for bias, the 4-hour chart for structure, and the 15-minute chart for execution. The first step is identifying the higher time frame bias on the weekly chart. In this scenario, price approaches a major swing high, which becomes our main point of interest. Instead of expecting continuation, we anticipate a liquidity sweep above the weekly high, followed by price returning back inside the trading range. If that rejection forms a bearish reaction on the weekly chart, we then establish a bearish higher time frame bias. Once the weekly bias is confirmed, we move down into the 4-hour chart for structural confirmation. Here, we wait for a change of character or market structure shift to align the 4-hour structure with the bearish weekly narratives. After the structural shift forms, we define the trading range and identify the optimal trading zone, or OTZ, between the 0.618 and 0.786 Fibonacci retracement levels. From there, we move down into the 15-minute chart for execution. Inside the OTZ, we will focus on two different entry models. The first uses a fair value gap and order block reaction inside the premium zone. The second uses CISD confirmation before execution. So, throughout this framework, the weekly chart provides the bias, the 4-hour chart provides the structure, and the 15-minute chart provides the precision entry used to align the entire setup in one direction. But even when traders correctly understand higher time frame alignment, liquidity, and structure, the market still creates one final trap that catches most participants before the real move begins. This trap is known as inducement, and understanding how it works can completely change the way you interpret pullbacks and liquidity sweeps. Price is trending higher, forming higher highs and higher lows. After that, a small pullback develops, creating a minor low. Early buyers step in and place their stop losses just below that low. Price then dips slightly below the low, sweeps those stops, and immediately reverses with strong momentum. This is the inducement move. Why does this occur? Institutions need liquidity to fill large orders without causing excessive slippage. That is why price often reacts so aggressively after inducement. The key lesson is simple. We do not enter zones blindly. Instead, we wait to see if inducement takes place. When it does, the probability that the zone will hold increases significantly. Now, after understanding liquidity sweeps, inducement, pullbacks, and higher time frame alignment, we arrive at one of the most important lessons in trading psychology. Even when traders understand the technical side of the market, many still lose money because they continue forcing trades during moments of confusion, emotional pressure, or unclear market structure. This leads us into the final lesson, because one of the most professional decisions a trader can make is recognizing when the market conditions, or even their own emotional state, are no longer aligned with high probability execution. So trader, if you cannot read the market clearly, do not trade. One of the biggest mistakes traders make is forcing trades when market structure is unclear. When price becomes choppy, emotional, or difficult to read, many traders continue searching for entries anyway. In most cases, this leads to impulsive decisions, fake breakouts, and unnecessary losses caused by emotional pressure instead of real confirmation. Professional traders understand that clarity is part of the edge. If the higher time frame bias is unclear, if structure keeps failing, or if liquidity behavior becomes confusing, the best decision is often to stay out of the market completely. Protecting capital during uncertain conditions is just as important as executing good trades during clear conditions. The market will always create new opportunities, but emotional trades taken during confusion can quickly damage confidence, discipline, and consistency. Sometimes the most professional decision is not finding another setup, but recognizing that your current emotional state or the current market conditions are no longer aligned with high probability execution. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.